How should you be positioned going into 2018? Are you fearing a meltdown or a melt up? Chris Watling, Chief Executive Officer and Chief Market Strategist at Longview Economics, joins us now. What is it that's going to take us through into 2018? What are your thoughts in terms of positioning?
The place to start is, where do you see markets going from here? And it's fascinating, actually, if you read around the subject, listen to market commentators, it's quite a lot of fear building. We brought in the Shiller PE ratio, for example, today as one chart that I think makes that point. And you can see the Shiller PE ratio is now actually at one of its highest levels in the last 120 years. And there you see we're running at about sort of 30 plus times.
This is price to earnings ratios, isn't it?
This is, cyclically adjusted price to earnings ratios. So today's price divided by 10 years of average trailing earnings. And what it shows you, and the idea behind it, is you're trying to capture the whole cycle. So 10 years is actually quite a long economic cycle, but it's fairly representative of a whole business cycle. So you can see valued relative to the business cycle, we're trailing actually roughly where the 1929 peak is, and only below what we saw in sort of 99, 2000. So this is one of the things people bring up as a reason to be fearful, along with our second chart, which is NYSE margin debt, which is as an expression of how much leverage brokers on the New York Stock Exchange are using.
What does this mean exactly? This means that people are borrowing to buy more equities?
Exactly. So it's a very old measure of margin trading. Margin trading, buying on margin of equities at the New York Stock Exchange by the brokers and people that run accounts at the NYSE. So, and this has been around for a long time. You can see here, there we are. We're basically back at the peak that we had originally actually in late 2015, just before that sell-off, but also the peak that we had in 99, 2000, just ahead of the top in the market there. So it peaked in February. The market top was March 2000. So it's a lot of margin on being used in buying equities, very expensive valuations, and these are some of the red flags some of the investors and market participants are starting to point to. I would say, however, don't look at that.
Why? What arguments would you say these are not important?
They're important. They're telling us something about the structure of the market and the longevity of the bull market. They're not good market timing signals. The Shiller PE ratio is great if you want to take a 10-year view. Margin debt helps you, but not really on a 12, 18-month view. I would say look much more closely at three things drive bear markets. Basically, tight money, an anticipation of a US recession, and shocks. And really that you can go back to the 1920s and demonstrate that point.
How tight is money, though? I mean, it's very difficult to say tight money. I mean, where are we now along that path? Because we've already got the Fed embarking on an interest rate rising cycle. Got the tapering of QE from the bank, from the European Central Bank. Bank of England started to raise interest rates.
Well, that's right. And people are starting to look at this thing called quantitative tightening now. And by early 2019, the major central banks of the world will be shrinking their balance sheet in aggregate. So we have the Fed doing it now, the ECB slowing its growth and so on. And there's this view that by early 2019, if you do the numbers, they'll be shrinking in total. And therefore, that's a concern. But I would say that's only half the picture. So money creation isn't just the central banks. It's the central banks plus the commercial banks. And of course, when the commercial banks weren't functioning very well post-GFC, you need the central banks firing all cylinders. Now, if you look across the spectrum, they're functioning pretty well. And M1 is a good way of doing that. It picks it all up.
Money supply, yeah.
Money supply. And M1 growth is really strong still. In fact, in the US, we're running about 9, 10%. So you know, I don't think money's tight at all. In fact, you can look at a whole range of indicators that got the same sort of message. That's not there yet.
So where should we be? Where is the keen money going into 2018?
Well, I think you know, if you're looking at a global asset portfolio, you should be overweight equities, and you should be, for my mind, overweight Western equities ahead of emerging market equities. And the reason I say that is because I think the dollar will strengthen over the course of 2018, and that's a negative for emerging market equities. And really, you want to go where, you know, you want to avoid the places where the shock risk is highest. And I think the third chart we have here is a chart of Chinese WMPs. These are the wealth management products in China that are now being regulated. So we had the Chinese Congress in autumn, the big political gathering. Post that, the leaders have decided to clamp down on a lot of this sort of money creation in the shadow banking system. And of course the background here is China's had the biggest credit boom of any economy, major economy in the last 30 or 40 years. So
explain what's going on here.
So what we have here is we have really an alternative channel for credit creation. So an alternative to the banks. And what's been happening in China, and in fact if you took this chart back to 2010-11, it would be almost at zero. And what we're showing is on the right-hand side is the total amount of WMP's wealth management products outstanding. And what's interesting about it, one is the acceleration of growth from 2010 to really late 16, and then since then the flatlining. And the flatlining of the total illustrates that actually there's not been any new credit creation in this channel in China in the last few quarters. And that's a problem, I think, when you've got an economy that's been run on high octane of lots of credit creation.
What about value against growth? I mean, you've got to have growth in order to continue to grow. It's companies to expand and share prices to rise and so forth. What about the value to growth?
Well, that's again, you see, this is what I love about markets. They have themes and psychology and phases. And indeed, if we look at the last chart, what you'll see is you get towards the sort of last innings of bull markets, as the Fed starts tightening, which you can see with the Fed funds or the 12-month policy rates there. In late 1998, for example, as the Fed starts tightening into the end of the cycle in March 2000 in terms of the bull market, the recession was 2001, but as the Fed's tightening over those 15 months, the value and growth starts splitting apart. And it's the beginning of the tightening that roughly signals the beginning of that splitting apart. And I think this is, as money gets more expensive, markets become more discerning, and they stick with what they regard as sort of the sexy theme. And of course in 98, 99, 2000 it was TMT, 2004 to 2006-07 it was really housing bubble, banks, AIG, anything related to that. And now what's interesting is it's the FANGs. And you can see here, since late 2014, as the Fed started tapering, 12-month bond yields have been moving higher. The market's been splitting apart value and growth. And of course there's this argument in markets today you should buy value, because of course there's a bit of a differential on a valuation gap between value and growth. But I would argue no, that's not the case. There's a psychology and a phase at the end of the cycle where you stick with the winners and what's really doing well, and you stick with the FANGs.
Long or short dollar in all this going into 2018?
I would be long the dollar. The market's bearish on the dollar. It's positioned short. And if I'm correct about US interest rates being above, the rate hikes being more than the market expects, that provides some underpinning, some dollar strength from here. So I like the dollar. If I look at somewhere like Europe, how much can they really tighten or indeed taper? I mean, consumer credit growth in Europe is 1%. In the US, it's 5, 6, 7%. It's a different quantum. Eurozone is not an autonomous growth unit on its own. It depends on global trade growth, US and China growing. It's this old market adage, you know, when the US sneezes, the rest of the world, and particularly Europe, catches a cold. So it's not an autonomous growth unit. I prefer the dollar in this next 12 months.
Yeah, just very quickly, next year, you should see a lot of progress towards the Brexit date of March 2019. How about sterling in all this? How about the UK in all this? One of the reasons why the Bank of England has raised interest rates is because of Brexit. I think that's one of the reasons as to why they've maybe cut it down too far in the first place. But what about the Brexit effect here in the UK?
Well, good question. I mean, for me, actually, Brexit is a little bit of a sideshow to the UK economy. I think structurally the UK economy is one of the weakest economies of the Western economies. We already have a housing bubble. We're very dependent on credit creation, consumer credit. We're spending beyond our means. We have the largest current account deficit of major Western economies. I mean, it's a long, long list, and Brexit, of course, doesn't help your growth profile near term on that. So for Carney, I think it's a very difficult job, because as the world raises rates, you sort of need to try and follow. And if you don't try and follow, your currency weakens. So he's really stuck between a rock and a hard place. So sterling seems cheap, but actually I think it's probably, over the next 12 months, there'll be a nice time to go short that currency.
Okay. Look, we'll have you back in before then. But Chris, in the meantime, thanks indeed for joining us.
Thanks very much.
Happy New Year to you and everybody at Longview Economics. That's Chris Watling, the Chief Executive and Chief Strategist at Longview.